Welcome to the Growth Experts Podcast. I'm your host, Derek Colin. And in today's episode, we have Ignacio. He is the partner over at L40. How you doing today?
How you doing, Derek? Thanks for having me.
Good. Pleasure. So can you share with us a bit about your background and how your investment thesis or advisory approach fits into the bigger picture over at L40?
Yeah, so a little bit of background about ourselves is we started as a lender, actually. So we raised a $250 million fund to help smaller M&A transactions in the tech space. So we started with e-commerce, then we rolled up into SaaS, marketing agencies, content sites. Over time, we started helping our customers kind of sell some of the assets that they had acquired through our portfolio. And ultimately, at the end of 2024, we sold the debt portfolio to Founder Path, which is a strategic lender based out of Austin, US. And we continue with our sell-side advisory firm. So we rebranded to L40, stands for Latitude 40. And we're a sell-side M&A boutique focused on tech companies. We're headquarters in Miami, but we also have offices in Portugal and Spain.
Oh, cool. Awesome. So Portugal, Spain, and headquarters in Miami, you said, right?
Yep.
Oh, very cool. So what does a typical day look like for you? Deal making or portfolio management? What is that?
So right now what we're doing is we focus on the sell side mostly. We have a couple of buy side mandates, which are companies that want to grow inorganically. So they hire us to kind of make the go-to-market strategy for them, talk to founders, and kind of lead their way for an M&A acquisition strategy. But that's kind of like the smaller side of what we do. Typically, we're talking to founders and kind of helping them navigate through the exit process. Now, founders may think that it's an easy process, but if you look at it, it takes at least 9 months to sell a business. There's a lot of work that has to go through it. Even when you get a mandate, there's a lot of work to do. But before getting a mandate, you have to speak to founders 2, 3, 4 years in advance, kind of keep them insights on what's going on in the market, who's buying, who's selling, who's raising capital, what are the market valuation multiples that we're seeing, because it changes, right? And you want to make sure that whenever you go to market, you want to maximize the outcome of the valuation of the business. So you got to keep an eye on the multiples. Many founders believe that their company is what all matters on valuations, but actually the market has a big role into valuations, right? So you need to keep an eye on the market, whether you're thinking of selling or right now or maybe in the future. Maintaining the business is growing may not always be the right decision, right? We're at a point right now where AI is eating everything out there in the market. It seems like there's a crisis with the credit funds. We don't know what's going to happen down the road with the private equity firms, SaaS businesses. So if you're a SaaS founder, don't underestimate the market. And if you're thinking about selling, this might be a better moment than 2 years down the road, even if you manage to grow the business, right? So internal KPIs are not always going to be the ones that determine or maximize the value of your business. So that's basically, to answer to your question, our everyday, what it looks like is just talking to founders, talking to VCs, talking to private equity, talking to strategic buyers within the corporate development teams, within the strategic buyers, and kind of understand what's going on in the whole M&A industry within tech.
Oh, very cool. Awesome, man. Well, so how did you get into tech per se? Was it something you guys were thinking about ahead of time when you were building it out, or has it always been tech?
So for me, it's been kind of like a unexpected journey. Started actually in the tobacco industry, believe it or not. But I soon realized that the tobacco wasn't going anywhere. If you're thinking about joining an industry, whatever it is, you got to make sure that that industry is thriving and it's actually increasing, and the total addressable market is growing and there's new opportunities. Otherwise, you're just not going to grow personally. So for me, identify that technology was the place that I wanted to be, because the industry was thriving. There was current on that water as opposed to the tobacco industry. So I changed about 10 years ago to a small startup fintech company that ended up getting acquired. I was part of the founding team in the previous 250 million fund that I talked about previously. And then from there, it was just very natural to start kind of working with companies and helping them sell some of the assets that we had previously financed, because obviously we did the due diligence. We knew the companies, we knew the buyers. It was a very natural shift for us. And then from there, when we sold the fund, it was a very natural shift also for us. The three partners here at the firm, we came together and we decided to start NL40 because again, it was just natural for us to what we had been doing for the past 10 or 8 years. So it was a very natural shift. It wasn't something intended. It was something that took me here.
Okay, awesome. Well, it all worked out for the best, I assume. That's very cool, Mark.
Now I can't complain. Let's see what's going to happen in the next couple of years. But it seems like everything's pointing out that M&A is definitely going to be one of those industry that is thriving.
Yeah, for sure. I see it too. And that's why we're here. So what major shifts are you seeing in the M&A space or, the landscape right now?
So yeah, first of all, one of the biggest shifts we've seen, if you look at what companies were valued in the last 10 years, we come from kind of like a VC world where companies were being valued at how much you grow, how big is the team, but they were not really paying attention to profitability and EBITDA margins because people assume that you will ultimately get there, right? So we saw a lot of valuations that were being based upon ARR or revenue, right? And the whole thesis was, hey, you have to grow as fast because you're going to be valued at revenue. So don't worry about any other KPIs, but growth and perhaps team members. But now what's happened is with the new generation of founders leveraging AI, they're being able to build much more robust teams with a smaller workforce, and they're able to be profitable much sooner. So private equities, the whole market really is captivating that and an understanding that you don't need much to be profitable. So the whole landscape is changing, right? So now we see it very clearly with legacy technology companies that have raised Series A or B. They raised capital in 2021, 2022, where the multiples were very, very high. And the new companies are very slim. They're barely raising any capital. They're profitable since day one. And the difference between the VC and the M&A is VC market is always going to value you at what are you going to do in 5 years, right? Whereas when you sell a business, buyers going to value you at what you've done for the last 12 months and what are you going to do for the following 12 months, right? And that's like what they use to measure you and value you. So what we're seeing is that there's all legacy companies that raise VC capital in 2021, 2022 at 10x valuation, 10x revenue. When they try to go to market for an M&A transaction, they're just not seeing the valuations they expected. There's a big gap between what investors are expecting and even founders and what the M&A market is offering them. So the first thing that we're realizing is that it's no longer on revenue, what measures are being taken to value a company, but rather EBITDA margin has a lot of weight that didn't have before. So we're starting to see a lot of offers coming from both strategic buyers and financial buyers on a basis of a multiple on EBITDA and not revenue. So we're seeing that transition. And I think if you're a founder that have raised capital, you're not yet profitable, but you're thinking about selling, the number one metric right now, without a question on the market, is Rule of 40. Rule of 40 is the year-over-year growth plus your EBITDA margin. And if it's above 40%, so you're growing 20% and you have a 20% EBITDA margin, you are at the Rule of 40. The higher you are from that Rule of 40, the higher that valuation is. Now, that Rule of 40 has to be balanced out. It cannot depend solely on growth. It also depends on margins, right? So if you're a founder, you've raised VC capital, you start burning cash, you need to get into that profitability path as soon as possible because you have a huge number of new founders that are leveraging AI that are setting the foundations for a much rapid growth, and they're going to be profitable very soon, right? So we're going to start to see a lot of legacy products that are not going to be able to sell because of everything that I've just mentioned. So that's one thing that we realized in the market. Also, the most active buyers currently are strategic buyers that are backed by private equity, and that kind of makes sense if you think about it. Usually, you have two types of buyers: pure private equity, financial buyers, and strategic ones. But within the strategic buyers, you can differentiate the ones that are buying through their own balance sheet and their own capital, and the ones that are backed by private equity. And it makes sense that the most active buyers are the strategic buyers backed by private equity, because the whole private equity strategy has been buy and build, right? So when they make an acquisition, they're constantly looking for potential add-ons to that acquisition. So they're very acquisitive and they have a lot of capital. So those are the most active buyers that we're seeing in the space. Now, we don't know what's going to happen in the near future. There's a lot of conversations about the private equity crisis, and they're not being able to sell some of the assets that they have acquired. I think there's a lot of capital being held back prior to IPO. And if we don't start seeing massive IPOs in the next couple of years, let's say, we believe that we might see a big private equity crisis, because you have to be able to exit some of those portfolios of private equities soon.
I see. Yeah. So it seems as if, because I've noticed in the news, BlackRock, they look like they're partnering with an AI company. I forget the name of the AI company, but it looks like there's some major shifts going on when it comes to PE or EBITDA multiples and interest rates, and there's a huge shift. So in that regard, how has this market shift in terms of old legacy, silver tsunami, if you will, how has this shift, in EBITDA multiples impacted your deal flow? Or
Yeah, well,
that?
yeah, the first thing that we're seeing, if you look at the more legacy SaaS products on the public market, you're seeing all of them are mostly trending down. So you look at Salesforce, HubSpot, and all of these similar companies, they're trending down, and their valuation is shrinking within the public market. That kind of makes sense, because nowadays with AI, there's many of the tools I used to hire that you could do internally, right? Now, I'm not excessively worried about that. I just think that we're in a change of regime, where we need to see more IPOs of these new AI companies trading publicly, and those legacy companies will ultimately shrink down, but they will be replaced by the new generation of companies that are backed by AI, right? So I'm not excessively worried about the publicly traded market at the moment. But obviously, if you are a bigger strategic player that is thinking of doing an IPO, as you know, there's two exit routes that you could take. Either you exit or you go public, right? So if you're thinking about going IPO, you better watch out for the publicly traded market multiples, because you're going to be valued based on those benchmarks as well, right? So if you're a strategic buyer thinking of a future IPO, and you're using inorganic growth to get to whatever revenue you want to get to prior to the IPO, you have to pay close attention to those multiples, because you are going to be valued at those multiples, right? So let's say if the publicly traded market is being valued at 15 times EBITDA, you're taking a risk if you're paying 25 times EBITDA for a business, because that's going to decrease your valuation whenever you go to market, right? So what we're seeing is that it affects definitely the publicly traded companies' valuations, affects the way buyers are thinking about acquisition. And we're seeing a trend on valuation based on EBITDA, as I mentioned earlier. But if we continue to see a downward trend on companies in the publicly traded market, that's going to affect M&A multiples as well.
Interesting. So when it comes to, sourcing and closing deals, what's working well for you right now, and, what's been frustrating?
So I think, as opposed to what everybody is trying to do nowadays, or I guess is because of the nature of our business, in-person meeting is always what gets you the best results. So actually meeting founders in person is what gets us the best results, and is able to build that relationship. But I guess it is quite specific for our industry, because if you're a founder, you're going to sell the business just once in your lifetime, right? So you want to make sure that whoever you work with, they've worked with similar businesses in the past. They're easy to work with. They're going to be serious. They're going to work 24/7 to get you the best deal, right? So it does make sense. Right now, what is working for us is just meeting founders at events. We're organizing a lot of dinners around the world. We've done New York, we've done Miami, we've done LATAM, Eastern Europe, Southern Europe, and we just organize these in-person events with founders to kind of give them some insights on what we're seeing in the market, what are the new trends that we're seeing in the M&A space? What are some of the private equity comments that we hear from our daily conversations? And we try to educate them on how to prepare a business in order to get an exit, right? And those have been working the best. I would say what frustrates me the most is that in general, this is a very slow industry. So if you think about it, it takes about 6 months to a year to sell a business when you have a mandate. It takes about a year, 2 or 3 years to actually get that mandate. So overall, the average lifespan of working with every customer is just very, very long, right? So it's not one of those industries where you could wake up and close 7, 8 deals per week. It's just very slow. So that's one of the things.
You have to keep filling the pipeline.
And you have to have a good mentality, long-term mentality, because what you do here, it could pay you off for the next 4 years, right? It's hard to sometimes understand that you're working for your future 4 year yourself, right? And that can be frustrating for a guy like me.
Yeah, yeah. So it's good that, you build relationships, you're organizing events around the world. I assume there's an initial outreach in order to identify that target or that client relationship that you want to build with someone that's within your ICP in regards to the niche that you guys are going after in the industry. So when you do that initial outreach, are you identifying them online? Are you calling them on the phone, jumping on a Zoom call, and then organizing an event for a face-to-face?
So we do all of the above. So sometimes we just organize an event and we invite people within that city kind of join us for dinner. We'll pay for dinner and everything. And that's just really 10 to 15 founders where we identify online and we invite them. Either we know them for past events or other conversations that we've had, or we just do outreach. We also do personalized outreach. Let's say, Derek, that I've seen you on LinkedIn or see a new about your company, that you've done something exceptionally well. So we'll prepare an outbound email specifically target just for you to kind of say, hey, I'm Ignacio, this is what I do. I would love to kind of jump on a quick call, introduce ourselves, tell you what we're seeing, just in case you want to think about an exit in the future. And that's mostly what we do. So we do a lot of outbound. It's not mass email, it's just more targeted outbound where we identify the company and we send a very tailored email towards that founder to kind of trying to jump on a call and kind of give them insights on the M&A market.
Very cool, man. I love it. I love this world. I really do. Or this space. It's amazing. Whether it's M&A, PE, family offices, etc. And I'm glad that you're here on this podcast today. So thank you for being here. So what would you want sellers on the sell side or buyers to know, before they engage with your firm?
I would say that typically if you're a founder, you want to have these conversations with investment bankers much sooner than what you would typically do if no one told you this, right? So usually founders, whenever they're ready to go to market, that's when they will start looking for an advisor. I would definitely recommend you to start these conversations even much earlier than what you would naturally think, right? 2 years in advance, because you got to prepare the financials. You got to understand what buyers are going to value your business at. You want to have time to kind of maneuver around to make sure that all those KPIs that buyers are going to look for, they're maximized to the limit, right? So if you're having these early conversations, you're gonna understand what type of structures you could sell the business to, what are the main KPIs buyers are gonna look for, what are some of the things that you gotta take care of before going to market. To give you a very simple example, change of control clause within your customer contracts. Most founders don't even know whether they have them or not. We've seen recent transactions where we were doing due diligence and we realized that there was some change of control clauses, and that could definitely derail the whole transaction and you have to start all over again. Right? So smaller things like that you've never thought about, you want to make sure that you have these early conversations with investment bankers, even if you're not thinking about selling right now, but down the road, that's going to be the route that you want to take. For sellers, that's what I would like them to hear from me. From buyers, I would love to connect with you, trying to understand what's your investment thesis, see whether we can collaborate. And that's about it. I mean, I like talking to everybody. I really like to understand the overall market from every angle and perspective possible. So I've always answered every outbound inquiry that I received on LinkedIn or email, because I just genuinely want to speak to everybody, as much of people as I can, because I think ultimately that's going to kind of always add up, right? And sometimes I reach out to people, not even trying to sell them anything, but just to connect. And I don't hear back from them. I'm like, dude, I'm just trying to connect. Oh, why are you trying to not answering me? I generally think these are going to be a good conversation, because I always want to talk to everybody, right? So um, if you get reached out by me, just know that I'm not trying to sell you or anything. Just generally trying to have smart conversation,
Yeah.
and that's it.
Well, I mean, essentially, what your practice does is you have their best interests at heart. And you said it, like they need to be prepared 2 years in advance if they're considering or thinking about these kinds of things. And your firm and yourself, and you seem very knowledgeable in your industry to be able to provide that partnership, if you will, to facilitate whether it's the sell side or the buy side. And that outreach or that initial touch point is important, and it sounds like building relationships is a major factor in your organization, especially if you're organizing events and bringing people to dinner, to build that relationship and have those conversations, right?
Definitely, for sure. Yeah.
Yeah. Yeah, awesome, man. Well, how has speed, in terms of like speed to market or speed execution, helped your firm win deals?
So I would say in general, this is not an industry where speed is a game changer, right? Again, you're playing the long term. You're nurturing clients over a period of 2, 3, 4 years. So no matter how quick you move, if that founder is not ready to sell, they're not gonna sell, right? But overall, I would say making sure that whenever we talk to founders, we're preparing the best market research that we can, and also valuation report that we can, and we want to do it quick, right? If you're coming to us, hey, I'm thinking about selling, or someone came in with an offer, I want to see whether that offer is legit or not, or based on market trends. We're valuing the business, and we have to get a lot of information, and it takes time, but we try to do it as quickly as possible, right? We have the associates here and the analysts working long hours just to be able to provide that analysis as soon as possible, to make sure that we're getting the best outcome for our for our clients. And also, while we work with a company, it's just nonstop, where we're here until late at night, making sure that we're doing as much work possible on a day-to-day basis, to whatever extent we can expedite every process that we're in, right? Even though we understand that it's a long-term process in general.
Yeah, yeah. So I would say not speed in terms of rushing, the owner or founder to, relinquishing or divesting the acquisition, but more speed internally in terms of a hardworking, crack team that's gets all the documents.
Yeah, speeding. Hey, what's the natural length that this small project takes? Is it 1 week? Is it 2 weeks? Okay, so let's make sure that it's 2 weeks and not 2 weeks and a half, right? That's all the speed that we get, but there's so many things that we cannot do by one day. It's just the nature of the industry, and we're fine with it. We're comfortable, but if we can deploy it in 2 weeks rather than 2 weeks and a half, we're making sure that deploying it in that time.
Yeah. So where do you want Latitude 40's pipeline to be, or, portfolio in the next 6 to 12 months or beyond?
Yeah, so I would say so you have two types of investment bank companies, right? At least on the smaller side of the scale. You have the ones that are driven by a couple of partners. It's a lifestyle business. They're doing 4 or 5 transactions per year. That's it. Good fees, good lives. That's it. And then the other one is international scope, where you want to build a brand over time that last or outlast the partners, right? And that's the trajectory that we're on. We want to be in every major city around the world, at least tech-wise. We want to grow in partners. We don't want to maintain a team of three-pounder partners. We want to grow as much as possible. We're already in the US. We're getting good pipeline from LATAM. So we want to make sure that we're more focused there as well, and we're more present. I think the Eastern Europe, it's well underserved by all the major investment banks out there. So we want to focus there as well. So overall, 6 to 12 months, obviously, we're not going to have time to do all that, but just at least continue building towards that ultimate goal, which is to have representation in every major city or at least tech city around the world.
Mm, awesome. So every major city looking to expand. It all sounds amazing. And thank you so much, Ignacio, for being here. I mean, thank you for joining us on the Growth Experts podcast. For those of you, if you want to check him out, you can look up his name and information and company on LinkedIn. That's linkedin.com. And if you want to check out his website and maybe look into an advance in the next 2 years or so, maybe possibly selling out your company, go to L40.com. That's latitude40.com, L40.com. Thank you so much for being here, Ignacio. It's a pleasure.
Thank you, Derek. Appreciate it.